Hello, this is David Skarika, and I'd like to welcome you to my special presentation on long-term trading cycles and where we are in the long-term cycle. As you're reviewing this, you are a subscriber to my newsletter or a subscriber to my free newsletter. And right now, we're going to offer you a special offer to Addicted to Profits. Right now, I've just put together a 5-part series on long-term cycles in the markets, where the bull and bear markets are. And in this 5-part series, we give you explicit information on how to profit from these cycles. On top of just telling you where the cycles are, we're giving you stock picks, we're giving you exact advice on where to put your money in the coming years. Right now, we're in a very dangerous time for investors, especially Americans, because we are in a major bear market cycle. These cycles tend to last 15 to 20 years. At the end of a bull market, as in 1999, stocks or an asset class were very overvalued and it was time to sell. So at the beginning of the cycle, the asset class is undervalued and it's time to buy. And I think there is such asset classes out there right now. But right now, Americans are seeing their wealth eroded by printing of money, by huge government deficits, by the loss of the US dollar as its reserve currency status. And this is all translating to a major secular bear market for stocks. And I think right now you have to know where the bull market cycles are to protect yourself against this. And here's where I think they are. Gold and other commodities are mid-cycle, much where stocks were in 1990. In 1990, the Dow had quadrupled off its bottom, much like gold has gone up sixfold off its bottom since 2000. And then it continued to go higher for another 10 years. And that was about 8 years into the bull market. 1992, we were 10 years into the bull market. There were still another 8 years left. So that's where I think we are at the moment, that we have another roughly 5 to 10 years left in the commodities bull market. Bonds are nearing the end of the major bull market. Bonds are overvalued. For an indebted government to be yielding only 3.3% on its 10-year treasury is ridiculous and is not a good risk-reward proposition, especially with that country's currency declining in value. And Japan is at the end of a major bear market and in the beginning of a major bull market. So Japan is an asset class that's been going down for 20 years and is now undervalued. And I think Japanese stocks represent excellent opportunity. So here's an example. This is gold. It's in a major bull market. Now, there's been a lot of calls for gold to be a bubble and the whatnot. I do not see this. Number one, the Americans are going to continue to see their currency decline in value in the coming years. And we can see from a technical standpoint, this is a very steady increase in gold. In addition, some of the ETFs and closed-end funds I watch that track gold are now trading at discounts to their net asset value. This means that these things are getting very cheap. And actually, these are types of things that happen near the bottom in gold and gold stocks, not near a top. So right now we're in a steady increase, and I think that this increase is going to continue to go on for years. Same with most commodities. This is the CCI, the Reuters CRB index, which has been going up since 2001. And we can see, other than the quick setback of 2008, we have gone higher over the last 8 years. And I equated the 2008 pullback to the 1987 pullback in stocks. It was very short, very sharp, and was just a short-term pullback in the long-term bull market. And of course, after 1987, the market continued to go higher for the next 13 years. So if we see a similar scenario, that means that commodities could still go up into the 2020 period. And with the amount of money, again, being printed and the amount that it seems that the authorities in the United States do not care about the value of their currency, this could very well be the case. And to continue purchase commodities on dips is an excellent way to protect yourself in the long-term bear market cycle of the US dollar and bull market cycle in commodities. And this is stocks. Equities are in a bear market cycle. After an 18-year bull market from 1982 to 2000, stocks in the S&P 500 have been going sideways for the last 11 years. We can see that there's roughly a trading range of about 750 on the S&P to 15 to 1600. And what's interesting in these trading ranges, in my long-term presentation for my subscribers, I talk about how these trading ranges work and why probably in the next year we will see this rally top out and we will enter a sideways trading range with continuing to see increased inflation. So again, you have seen no gains in the last 10 years and even negative returns when adjusted for inflation or adjusted for the decline of American dollars. And as I showed you earlier, gold precious metals and commodities are a great way to protect yourself of this against this downtrend in equities and the dollar. Emerging markets are another thing that we talk about in our presentation. We give specific stock recommendations, specific ETF recommendations, emerging markets that we like. This is the classic example. This is India going back to 2000. We can see, unlike the S&P 500, which has been flat in the last 10 years, India has been in a major bull market, gaining over 200% in the last 10 years. And there are always these major setbacks in emerging markets because they are volatile. But those setbacks should be used as buying opportunities. India actually has a very low indebted consumer with saving rates up to 40 to 50%. And now this consumer is being unleashed as smaller, poor Indians are getting access to credit facilities. So India, it looks like a good play to me in the coming years, as do other emerging markets. And again, a great way to diversify out of your declining US dollars. And again, we give specific recommendations on India and other markets in our presentation. And again, and this is what the bottom looks like of a long-term secular bear market. After peaking in 1989, Japanese stocks have been going down steadily for the last 11 or 21 years. And we can see that the Nikkei is down 80%. There's valuation contraction. Many Japanese stocks are trading at half a book value and single-digit price-to-earnings levels, very similar to American stocks in 1982 before they went up nearly 20 years it went up for nearly 20 years. So I believe that many Japanese stocks are cheap. And again, in my newsletter, Addicted to Profits, we have specific recommendation on Japanese companies that we think are set to do well when the Japanese devalue their currency and we see huge gains in the Japanese stock market. And I think that these gains will offset any devaluation in the yen going forward. And I'm very positive on Japan. And I think actually one of the first kickstarts to the economy will be the rebuilding from the recent earthquake in Japan. So this is David Skrika signing off here. I hope you've enjoyed this video presentation on long-term investment cycles. This is a quick overview of the problems we see in U.S. asset markets going forward and why you must protect yourself and diversify out of them. And again, I have a five-part series in where I give specific advice on specific markets and how to prosper from these long-term cycles going forward. And actually, I've been predicting these long-term cycles for the last number of years, and now it's just coming to fruition. So again, we hope you join our special deal. As you'll see here in this email, we have, you can just click on the button to subscribe, enter your credit card information, and then you will be added to a member of Addicted to Profits. And on top of that, I write two other publications, the International Contrarian and Stock Chart of the Day, and you will receive these two publications for the price of Addicted to Profits. So all of this for $349, and this is a value of $900. So we hope you've enjoyed this, and we hope you become a subscriber to Addicted to Profits. Thank you very much.